I think if you take a step back and ask, what is the big question for investors now in mid-2021? It's got to be, is inflation coming? Have they overshot? And are they doing too much fiscal on the back of an economy that is already recovering rapidly, thanks primarily to vaccination? This was a question Larry Summers posed back in February. It didn't make him very popular with his friends in the Democratic Party, but it was the right question to ask, because clearly this is a very, very large fiscal package. Total price tag in the initial proposals close to $6 trillion, when the output gap is nothing like the one that we confronted after the financial crisis. So the big question, and here I think history is extremely helpful, is how are we heading, not just for transitory inflation, which the Fed admits is going to happen, but for an actual uncoupling of inflation expectations and a new inflation trajectory, unlike anything we've seen in decades. And that's the kind of question that I don't think an economic model can tell you. You need to think historically to try and get the answer. Well, I remember kicking around a couple of possible analogies. One was the way the US economy behaved after World War II, when controls, of which there had been a great many, were taken off. And you had a real surge of inflation. But I came to the conclusion that a better analogy was with the 1960s. And maybe that's appropriate because I've heard it often said by his supporters that Joe Biden is a transformative president like Lyndon Johnson. Well, certainly if you look at what happened under Johnson's presidency, he inherited an inflation rate below 2%. It had been pretty flat in the first years of the 60s. And then in two big jumps, inflation went to 3% to 6% by the end of the Johnson presidency. And that happened because fiscal policy was stimulative, Great Society plus Vietnam, and monetary policy under the Fed was too accommodative. And most people who've studied this would agree that the mistakes were made in the late 60s that led to the big inflation of the 1970s. I think that's the worry that you have to have if you're at the Fed. Alan Meltzer wrote this great history of the Fed, the late great Alan Meltzer. If Alan were here today, he'd be saying they're making the same mistakes they made in the 60s, but on a much larger scale. Because remember, the deficits and the balance sheet expansion of the late 60s is much, much less. They're both much less than we've seen in the past year. So I think there's a significant chance that you're going to get a rerun of that 1960s shift in inflation expectations, which then, of course, went even further in the 1970s when the oil price shock struck in 1973. And there's another historical analogy there that I think is important and worth thinking about. We talk all the time about green infrastructure, Green New Deals. Europe, America, most countries have bold ambitions to be carbon neutral at some stage in the coming decades. That is not a free lunch, contrary to what some people are claiming. I think that will impose significant costs when you actually work out what it means to transition away from things like shale gas to transition to so-called renewables. That is going to have a cost, maybe not as drastic as the oil price hikes of 73 and 79, but it is going to have an impact. And I could conceive of ways in which it actually could reinforce that existing inflation impulse. So what you've got, seems to me, is the initial impulse comes from fiscal and monetary policy. It's the Fed that just delays a little bit too long in tightening. And then you have some supply side factors like this energy transition that actually further reinforce the inflation tendency. Am I certain about this? No. Nobody can have total certainty about where this goes. But is that an appropriate historical analogy to consider? I think it is. Well, you had to get very defensive because, of course, it was inevitable that with all the disruption of production and supply chains, there would be a financial crisis of some sort. And in March it struck, and it was very severe. It extended right into even the US Treasury market briefly. So there were two things to say. Number one, you have to be ready and very defensive for this shock, because at some point everybody's going to wake up to the reality. And the second thing, of course, was, well, what will the authorities do under these conditions? And again, I think it was important to realize that if you were sitting at the Fed or at the Treasury, this may not have been a financial crisis, but it looked a lot like one by March. And so it wasn't difficult to predict that there would be very quickly quantitative easing infinity, a big expansion of the Fed balance sheet, as well, of course, as a great deal of spending, the CARES Act, which was very hastily improvised. So my sense was that there would be this temporary, very sharp shock of panic when people realized that this really was a global pandemic. And then a great fire hose of fiscal and monetary support would be turned on, rather as had been done in 2008, 2009, only on an even larger scale, because many people from that period had concluded we didn't do enough. So that was, again, a matter of applying history and trying to figure out how sustained that reflation would be. And it's not difficult when the Fed is signaling zero rates as far as the eye can see to anticipate rapid appreciation of financial assets. There were a few tricky questions, like, was gold a better bet than Bitcoin when things really were ugly? That wasn't an immediately easy question to answer. But the broad outlook was clear. Well, the answer was that Bitcoin was a much better bet than gold. And that wasn't immediately obvious. At first, they actually behaved rather similarly. I mean, everything sold off at that moment in March. But Bitcoin took off and gold did not in the rest of 2020. And so if you believed, as I do, that Bitcoin is a kind of digital gold, or maybe technically an option on digital gold, it was actually a better thing to hold in your portfolio than gold over 2020 as a whole. Well, first, Consuelo, credit where it's due. One of the beauties of Greenmantle is that I get to have conversations with people like Matt McLennan, and it was actually in conversation with him that the idea of an option on digital gold came up, because I had been asking, is this digital gold? And Matt said, think of it as an option on digital gold and it'll behave much more like an option. This was a brilliant insight. And I remember incorporating it into a new edition of my book, The Ascent of Money, back in 2018. So the question of what is Bitcoin or what is cryptocurrency has been around now since the financial crisis. Let's not forget the original paper that explained Bitcoin, the Satoshi paper, was published in 2008, the same year that Lehman blew up. And my initial response, I remember, was a kind of fuddy-duddy, old professor type response. This is not a credible challenge to existing payment systems. Don't even talk to me about this as money. And that was my response to my teenage son, another person whose opinion I greatly respect. But by the time we got to 2017, and he'd been nagging me for some years about it, I had to rethink my view. And I rethought it in a couple of ways. First, it's probably a mistake to think of Bitcoin as money. At least it might become money, but it's not money yet. But what it certainly can be is a kind of digital asset. And the same was true of Ethereum and other digital currencies that were being added to the ecosystem at that time. If you look back in history and asked, what is this like? Which is always my question. What's this like? It was a bit like the early days of equity finance. In 2017, people were using initial coin offerings, kind of the way the early equity issuers were using stocks to raise money in ways that were novel and quick and not encumbered with regulation. So my first take on crypto was, this is just a kind of new way of raising money. And in that sense, it's like the experiments with the early equity companies that produced the bubbles, the famous Mississippi and South Sea bubbles. So it was obvious, A, that you were going to get bubbles, because that's kind of part of financial innovation, but B, that something would survive when the bubble burst. And my guess was that although there would be this bust, that Bitcoin and other tokens, particularly Ethereum, would survive. And it would be a mistake to expect them to go to zero. Now, some, including some friends of mine, some people argued it's all going to zero. Bitcoin is expletive coin. I thought that was wrong, and my sense was that financial history tells you it's an evolutionary process. There are a lot of things that go extinct, but innovation ultimately will produce some survivors, and those survivors will then become really very important. So we saw that in 2020, in a moment of total panic, when it seemed as if not only the financial system, but potentially the international trading system would break down in the pandemic. A great many people, especially in countries with somewhat rickety banking systems, turned to crypto. And this adoption process, where people say, look, I should have at least some percentage of my portfolio in this, even if it's only 0.2%. My prediction in 2018 was that adoption process will drive the Bitcoin price up. If it's 0.2% of the portfolio of every millionaire in the world, then you're on $15,000 of Bitcoin. And if it's 1%, then it's 75,000. And that gives you a range, I think, of roughly where things have gone in the past year.